You know where your money goes, you just don't know why. You know where your money goes, you just don't know why. Pull up your bank statement from last month. Not the summary, the actual line items. Every transaction, in order, the way they actually happened across the days. Most people, when they do this, experience a specific and uncomfortable sensation. Not shock, you knew, roughly, that you were spending. Not ignorance, you can recognize every charge, explain every purchase. But something quieter than either of those. A kind of mild estrangement from your own behavior. A gap between the person who made these decisions and the person now reading them. I bought that twice in the same week. I forgot that subscription was still running. I spent how much on that in that particular month? The gap isn't about the numbers. It's about the distance between what you thought you were doing and what you were actually doing, between the narrative of your spending, the story you carry about yourself as someone who is reasonably careful, reasonably intentional, and the raw data of your spending, which tells a different and more specific story. This is not a failure of character. It is not a willpower problem. It is something more interesting and more structural than either of those framings. It is the blind spot. Every person who spends money, which is every person, operates with a set of perceptual gaps, cognitive distortions, and emotional processes that shape financial decisions below the level of conscious awareness. These are not random. They follow patterns. They have names. They have been studied, replicated, and documented across decades of behavioral economics and cognitive psychology, and they are almost never discussed when we talk about money. Because we prefer to talk about budgets, about discipline, about the right system, about the right mindset. We prefer the framework that flatters our sense of rational agency. The blind spots are less flattering, but they are more real.
The abstraction of currency, moving it further from physical, sensory, immediately felt reality, reduces the pain of paying, which reduces the psychological brake on spending, which increases spending. And the trajectory of payment technology is entirely in the direction of further abstraction. Tap to pay, one-click purchase, subscription billing that removes the transaction from conscious awareness entirely, buy now, pay later services that further defer and distribute the felt cost of acquisition. Every innovation in payment convenience is simultaneously an innovation in pain of paying reduction. This is not a conspiracy. It reflects genuine consumer demand for convenience, but its cumulative psychological effect, the steady erosion of the felt reality of money leaving, is a force that operates on spending behavior well below the level of conscious intention. The second blind spot is mental accounting, a concept developed by the economist Richard Thaler that describes one of the stranger features of how people actually relate to money. The classical economic model assumes money is fungible. $1 is $1, regardless of where it came from, what account it sits in, or what mental category it has been assigned to. This is mathematically true and psychologically false. People do not treat money as fungible. They treat it as categorized, divided into mental accounts that carry different psychological weight and different implicit rules about how they can be spent. Money that feels like a windfall, a tax refund, a bonus, an inheritance, is spent more freely than the equivalent amount of money that arrived as ordinary income, even though the purchasing power is identical. Money designated for one purpose resists being redirected to another, even when the redirection would be objectively sensible. Money in a savings account feels categorically different from money in a checking account, even though both are equally accessible. This has observable consequences. The person who keeps money in a savings account earning 0.5% interest while carrying credit card debt at 24% is behaving irrationally by the classical model. They should simply use the savings to pay down the debt. But psychologically, the savings account is savings, protected, designated, carrying the emotional weight of future security, and the credit card debt exists in a different mental account with different rules. The accounts don't talk to each other the way a spreadsheet would suggest they should. Mental accounting is not always dysfunctional. The practice of earmarking money for specific purposes, of giving different pools different psychological identities, can support savings behavior and prevent impulsive spending in some contexts. The problem is that mental accounting operates unconsciously and inconsistently, sometimes protecting against poor decisions and sometimes producing them, and the person doing it almost never has clear visibility into which is happening. The third blind spot is anchoring, and it is one of the most powerful and pervasive of all cognitive biases in the financial domain. The anchoring effect, first documented by Tversky and Kahneman in 1974, describes the tendency to rely disproportionately on the first piece of numerical information encountered when making subsequent numerical judgments. The anchor doesn't need to be relevant, it doesn't need to be accurate, it just needs to exist, and once it exists, it exerts a gravitational pull on all estimates that follow.
In the context of spending, anchoring operates everywhere. The original price shown next to the sale price is an anchor. The highest price item on a restaurant menu, the one that seems absurdly expensive, is an anchor that makes the second and third most expensive items feel reasonable by comparison. The suggested donation amount on a charity form is an anchor. The manufacturer's suggested retail price on a car window sticker is an anchor from which negotiation begins, rather than a figure that has any particular relationship to what the car is actually worth. Retailers and marketers have understood anchoring for far longer than the academic literature had a name for it. The entire practice of marking items as on sale from a higher price, sometimes a price at which the item was never actually sold at scale, is an exploitation of anchoring. The anchor creates a reference point against which the current price is evaluated, and the evaluation is relative, not absolute. It is not, is $80 a reasonable price for this item, but is $80 a reasonable price given that the original price was $200? Those are different questions with potentially very different answers, and anchoring ensures that the second framing dominates. The blind spot here is the invisibility of the anchor itself. Once an anchor has been set, it doesn't feel like an arbitrary external number. It feels like relevant context. It feels like information. And the adjustment away from it, which research consistently shows is insufficient, feels like independent judgment, even when it is still substantially shaped by the anchor's gravitational field. The fourth blind spot is one that I find particularly worth examining because it operates at the intersection of psychology and identity in ways that go largely unacknowledged. It is emotional spending, not in the obvious, dramatic sense of retail therapy as a response to acute distress, but in the subtler, more chronic sense of spending as emotional regulation. The research on this is fairly consistent. Emotional states, specifically negative ones, but also some positive ones, reliably shift spending behavior in ways that have nothing to do with the goods or services acquired. Sadness, in particular, has a documented effect on spending. Studies have shown that sad people are willing to pay significantly more for goods than neutral state people, apparently because the acquisition of something new provides a temporary sense of agency and self-definition that counteracts the passivity and helplessness associated with sadness. But it extends well beyond sadness. Boredom produces impulsive purchasing, the online scroll that ends in a checkout. Anxiety produces compensatory spending, the sense that acquiring something provides a feeling of control over circumstances that feel uncontrollable. Social discomfort produces status-oriented spending, the purchase that signals competence or belonging in a context where those feel threatened. The key feature of emotional spending, in most of its manifestations, is that the emotional trigger is not consciously identified as a trigger at the moment of purchase. You don't think, I am anxious about work and therefore I am buying this jacket. You think, I need a new jacket. This one is good quality. It's a reasonable price. System 2 generates the rational narrative. System 1 had already made the decision for reasons that had nothing to do with jackets. This is not a character flaw. It is a feature of how emotional regulation and decision-making interact in the brain. But it means that spending patterns contain emotional information. They are documents of your inner life, not just your material preferences. And most people never read them that way.
The fifth blind spot is the subscription trap, which sounds trivial, but which represents one of the more significant structural shifts in how money exits modern households. The subscription economy is one of the most consequential developments in consumer spending behavior of the past 2 decades. Not because subscriptions are inherently a bad deal, sometimes they are, sometimes they aren't, but because the subscription model is specifically engineered to exploit several of the cognitive vulnerabilities already discussed. It eliminates the pain of paying by automating the transaction and removing it from conscious awareness. It exploits Michael accounting by making spending feel like a fixed cost rather than a choice. It leverages the status quo bias, the strong human preference for leaving existing arrangements unchanged, because canceling a subscription requires active effort in a way that not subscribing never did. And it benefits from what researchers call the ostrich effect, the tendency to avoid looking at financial information that might be uncomfortable, because subscription charges are small enough to not trigger alarm while accumulating into something significant in aggregate. The average American, in surveys, consistently underestimates their monthly subscription spending by a meaningful margin. The actual figure, when all subscriptions across streaming, software, services, memberships, and apps are totaled, tends to be notably higher than the estimated figure. Not because people are foolish, but because the architecture of subscription billing is specifically designed to minimize the salience of the expenditure. What's worth noting here is not that subscriptions are bad, it's that they represent a case where the payment mechanism and the consumption experience have been deliberately decoupled in a way that reduces the felt reality of spending. The service feels ambient, the cost feels invisible, and invisible costs don't get included in the mental model of what things cost. The sixth blind spot is future self discontinuity, the psychological phenomenon in which your future self feels less real, less vivid, and less connected to your present self than your present self does. Research using neuroimaging has shown something remarkable. When people think about their future selves, the brain activity patterns more closely resemble thinking about a stranger than thinking about oneself. The future you, the person who will be dealing with the consequences of your current spending decisions, who will be approaching retirement with whatever savings you have accumulated, who will be carrying whatever debt you've generated, is not experienced as a fully continuous extension of your present self. They are experienced as a more distant, less real entity. This has direct consequences for saving behavior and debt behavior. Saving is fundamentally a transfer from present self to future self. Debt is fundamentally a transfer from future self to present self, and if future self doesn't feel fully real, doesn't feel like you in the same way that present self does, then both of these transfers are psychologically distorted. Saving feels like giving money away to someone else. Debt feels like borrowing from someone who isn't really you. The research of Hal Hirschfield at UCLA has shown that increasing the felt vividness and continuity of the future self through various psychological interventions reliably increases saving behavior. When future self feels more real, the motivation to protect it strengthens. When future self remains abstract, present desires dominate the calculation almost by default.
Here's what becomes visible when all of these blind spots are laid out together. The typical framework for addressing poor spending habits is behavioral. Track your spending, create a budget, set savings goals, use the envelope method, automate your transfers. These are not bad suggestions. Some of them genuinely help. But they are interventions at the level of behavior, applied to a problem that is substantially operating at the level of psychology. A budget doesn't address the pain of paying differential between cash and card. A savings goal doesn't address future self-discontinuity. A spending tracker doesn't address the emotional triggers that drove the decisions being tracked. These tools are useful for the person who already has relatively accurate self-knowledge about their spending psychology. For the person who doesn't, and most people don't, they add a layer of structure to a process whose underlying mechanics remain invisible. This is why so many people who try budgeting fail at it, not because budgeting doesn't work, but because the budget is a rational instrument being applied to a decision-making process that is substantially non-rational. The budget assumes that the problem is organizational, that if you just know where the money is supposed to go, it will go there. The psychological evidence suggests the problem is deeper than that. The money goes where it goes because of processes that the budget doesn't touch. There is something worth sitting with here about the relationship between self-knowledge and financial behavior. Most financial advice operates on an implicit assumption that the path to better financial decisions runs through better financial knowledge. Learn more about investing, learn more about compound interest, learn more about tax efficiency, as if the binding constraint were information about the external world of finance. But the blind spot research suggests that the binding constraint is often information about the internal world, about your own psychological processes, your emotional triggers, your cognitive biases, the specific ways in which your spending patterns encode information about your inner life that you haven't consciously examined. A person who understands that they spend impulsively when anxious and can recognize the anxiety before it drives a transaction has more financially useful self-knowledge than the person who can construct an optimal portfolio allocation but has no visibility into why their spending spikes in certain emotional conditions. That kind of self-knowledge is harder to acquire than financial knowledge. It requires a different kind of attention, slower, more personal, less flattering. It requires looking at the bank statement not just to categorize, but to interpret, to ask not just where did the money go, but what was I feeling when it went there? What was I trying to solve? What did I think this purchase would give me, and did it give me that? Most people never do this, not because they're incurious, but because the cultural frameworks available for thinking about money don't include it as a legitimate category of inquiry. Money is for math, not for psychology. Spending is for budgets, not for self-examination.
Here is where the broader cultural context matters. The spending blind spots don't operate in a vacuum. They operate inside an economy that is specifically and deliberately engineered to exploit them. The elimination of payment friction isn't accidental, it's a business strategy. The subscription model wasn't invented for the consumer's convenience. It was invented because predictable recurring revenue, supported by status quo bias and the ostrich effect, outperforms transaction-based revenue. The anchor prices are placed where they are because anchoring works. The emotional content of advertising, the aspiration, the social belonging, the fear of missing out, is there because emotional triggers bypass the rational evaluation that might otherwise question the purchase. This is not a conspiracy framing. No individual executive is sitting in a room deciding to exploit your amygdala. But the competitive pressure of consumer markets selects for strategies that work. And the strategies that work, reliably, are the ones that find and press on cognitive vulnerabilities. The market has learned your blind spots faster than you have. Understanding this doesn't neutralize it. Knowing that anchoring exists doesn't make you immune to anchors. Knowing that subscription billing exploits status quo bias doesn't make it effortless to cancel the subscriptions you've accumulated. The knowledge helps, marginally, but the biases are structural, fast, and operating below the level where knowledge typically intervenes. What the knowledge does, and this is not nothing, is change the relationship between you and your own behavior. Instead of the post-purchase rationalization being the whole story, it becomes a story you can interrogate. The gap between decision and reflection doesn't close, but it becomes visible. And visible gaps, over time, can be worked with in ways that invisible ones cannot. The deepest blind spot of all, and the one that makes all the others harder to address, is the one about identity. We do not experience our spending habits as habits. We experience them as expressions of who we are. The coffee you buy every morning is not just a transaction. It's part of your morning, your ritual, your sense of how you move through the day. The restaurants you go to are not just where you eat. They're part of how you think of yourself as someone who appreciates food, who has a certain kind of life. The clothes you buy, the technology you use, the way you decorate your space, these are not just purchases. They are, in the cultural language we've all absorbed, statements. This is why spending is so difficult to change, even when the motivation to change it is genuine. Because changing spending means, at some level, changing the daily texture of how you move through the world. And the daily texture of how you move through the world is entangled with the story of who you are. The person who cuts back on restaurants doesn't just eat differently, they feel different about themselves, slightly less like the person they thought they were, slightly more like someone who is deprived or diminished or making do. Even when the financial logic of the change is entirely clear, the identity disruption of it creates resistance that the financial logic can't fully overcome. This is not a reason to not change spending habits. It is a reason to understand what is actually being asked when that change is proposed. It is not just behavioral. It is, in a quiet way, existential. And treating it as merely behavioral, as though the only obstacle were laziness or lack of discipline, misses most of what is actually going on.
Here is where I want to land. The blind spot is not the enemy. This is worth saying clearly because the entire register of personal finance content treats cognitive bias as an obstacle to be overcome, a weakness to be strengthened, a gap to be closed through the right system, applied with sufficient discipline. But the blind spots are not arbitrary malfunctions. They are features of a cognitive system that evolved under very different conditions from the ones it now navigates. The pain of paying was adaptive when spending meant giving away something physically scarce. Future self-discontinuity may have been adaptive when the future was genuinely less predictable, and planning for it was less useful. Mental accounting, however imperfect, provides a scaffolding for financial decision-making that pure numerical rationality, for most people, doesn't replace effectively. The problem isn't the blind spots themselves. It's the gap between the environment they evolved for and the environment they're now operating in. A gap exploited by every sufficiently sophisticated commercial interest in the modern economy. What might actually help, more than another budgeting app, more than another financial literacy course, is the slower, quieter, more uncomfortable work of developing genuine visibility into your own financial psychology. Not to eliminate the blind spots, which isn't really possible, but to know them well enough that they stop operating entirely in the dark. To look at what you spend and ask what it means. To recognize the emotional weather that precedes impulsive transactions. To feel the difference between a purchase that reflects a genuine value and one that reflects a mood, a comparison, a vulnerability that was pressed at the right moment by the right stimulus. That kind of attention is not a system. It doesn't produce a plan. It produces something harder to quantify and more genuinely useful. A clearer picture of who you actually are when you're spending versus who you thought you were. The gap between those two things is the blind spot. and the first step to navigating it is simply to see that it exists. Thank you for staying with Void Wanderer until the end of this episode.